So, Wall Street expert Tom Lee has said that while recently things are looking uncomfortable, the outlook for 2025 is looking pretty decent. Now, just to kind of provide a quick recap, right? This is a screenshot of the first week of 2025. Year to date, the market is down 1.44%, so we're not starting off on the best foot. And one of the things I mentioned in my previous videos on the contributing factors for the market falling down was number one being the 10-year treasury yield kind of rising back to what we saw back in April, which of course doesn't bode well for stocks, right? Because when the 10-year treasury yield increases, well, it creates this risk equity premium where investors are flocking towards buying bonds and getting the guaranteed return of these yields rather than a risky asset like stocks. And so that's one of the main backdrops for why stocks are falling. But also, I mentioned how the Dixie, which is the US dollar index, just the greenback, the dollar, is climbing up. It's kind of making new highs almost every single day. And I mentioned in a different video, I won't go ahead and delve into the specifics, but with the dollar increasing, it also doesn't bode well for stocks, right? And just to give two quick scenarios, I promise I won't linger on this too long, but if you're an international company and you get sales from different currencies in different countries, well, now changing or converting that currency to US dollars actually costs more. So you lose money there, but also you don't get foreign investment as much as you do when the dollar is lower, simply because it's too expensive for a lot of foreign buyers. And so those are just some aspects of to why when the dollar increases, it's not the best for stocks. I know it kind of gets a lot of individuals confused because when the dollar goes up as a consumer, it's great news. This is a time to go ahead and travel because you go to, some country in Asia, you're going to be living like a king when your dollar converts to such a high rate here. So that's just a couple of the things. Now, I quickly want to go ahead and play this clip here from Tom Lee and kind of share a couple of things that he mentioned here. So let's go ahead and talk about it.
10-year yield touching its highest level since April earlier today. But our next guest says the rise in yields could be a false flag. Let's bring in Fundstrat Head of Research and Fundstrat Capital CIO, Tom Lee. He's also a CNBC contributor. Tom, good to see you. Okay, so let's start there with the yield impact. What might people be reading wrong, you think?
Well, I wouldn't say markets are necessarily reading it wrong, but I would say as uncomfortable as we are seeing yields at near one-year highs, I don't think that this is going to be the level we see a few months from now. And I think that's more important because ultimately, if yields begin to fall because inflation pressures are easing or if the job market is a bit softer than expected, it really puts the Fed back in focus. So I guess what I would just say is, it's not comfortable to be here at where yields are. I don't think it really breaks markets, but I don't think yields are necessarily moving higher over the next few months.
So with that said, I also wanted to point out to something else pretty interesting. Now, one of the main reasons we saw the market fall down just the other day was because we had the job market actually looking good. And I know that may kind of confuse a lot of people. What do you mean the market's falling down if jobs are good, right? Well, the reason being is because of the strong labor report that we got from December. There's this fear that now the Federal Reserve has this concern of inflation rising up again. And because of that, there's this idea that they're not going to be cutting rates as rapid as they did before. I know it kind of gets a bit confusing sometimes when you think about it, but one of the things I kind of want to put into perspective is that although the job numbers that we got in December were really good, it really doesn't tell the full story. And in the screenshot, if you could want to pause this video, could just read it. But it mentions that it kind of masks the softness that we're seeing in the labor market. And it's not a good picture because it was really just four industries that did really well for December. There was government, retail, leisure, and hospitality. And in reality, it's not really a good strong of breadth for all the different industries, but also there's this kind of seasonality aspect that takes place with the job numbers from December, right? Because of course a lot of people during the holidays end up taking those temporary jobs, and so that's something that kind of may get cause things to have like a bit of a fluke in the data, and then we may end up getting a revision like we often do in the future. And so that was kind of one of the reasons why the market fell. But again, I kind of want to put into perspective that what Tom Lee is saying is that the inflation expectation or the picture for inflation is likely to come downwards, and that's going to likely bring the yield down as well, which is going to boost stocks. Hopefully this didn't kind of go over, in circles with too many of the concepts. And when you're talking about the 10-year treasury yield, job data, and then the dollar, and then the stock, it kind of gets a bit confusing. But with that said, I encourage you guys to watch this video right over here. It was actually a video I did a couple of days ago. This way you guys could go ahead and see a breakdown on just how I try to analyze the stock market. And with that said, I'll see you guys on that next video. Take care, guys.